I'd like to welcome all the registrants to today's webinar, The Paradox of Accounting for Cultural Heritage, a longitudinal study on the financial reporting of heritage assets of major Australian public cultural institutions, a longitudinal study from 1992 to 2019. Before we get started, we're just going to give the attendees just one more minute to dial in before we formally start today's webinar. The sequence of events will be, I'll make the introductions to the authors of the paper. I'll explain some of the housekeeping rules today about how we're going to be responding to questions, and then we'll get started with the webinar. So just one more minute to go and we'll start. And we'll start now. Well, firstly, I'd like to say thank you to everyone for joining us on today's webinar. I'm equally delighted at the opportunity of having our authors speak directly to you today about their research. In a moment, I'll be going through the author biographies of Dr. Paolo Ferri, Dr. Shannon Sidaway, and Emeritus Professor Garry Carnegie. In terms of how today will flow, we will keep strictly to the hour. And so what this means is that we've got a 20-minute allocation of speaking for each of our co-authors today. But what we will also aim to do is field as many questions as we can in the chat function, which you will see to the right-hand side of the viewing pane. I would urge you to post your questions there. We will leave some time towards the end for some direct responses from the co-authors. Those questions that are of a more technical nature will be responded to in written form by the co-authors. So don't feel as though your questions aren't being addressed. You will receive a direct response from one of the co-authors. I would urge you to post all your questions in the chat box. With that, I'll start with the biography of Dr. Paolo Ferri. Paolo is an Associate Professor in Accounting and Director of the Master Degree in Innovation and Organisation of Culture and the Arts at the University of Bologna. Before joining the University of Bologna, Paolo Ferri was a lecturer in accounting at RMIT University in Melbourne between 2015 and 2016, and postdoctoral fellow at the Stockholm School of Business 2013 to 2015. Paolo Ferri's research deals with the study of change and innovation in accountability systems among complex and professional organisations, and has been conducted mainly among cultural organisations such as museums, archaeological sites, and opera houses. Dr. Shannon Sidaway, CA, is a lecturer in the School of Accounting, Information Systems and Supply Chain at RMIT University. In addition to a role at RMIT, Dr. Sidaway has acted as a mentor and facilitated workshops as part of the CA program for Chartered Accountants Australia and New Zealand. Prior to joining RMIT, she worked in a business advisory role, providing accounting and taxation services to clients from a range of industries, including the not-for-profit sector. She currently serves as an elected councillor on the CANZ Victorian Regional Council, representing the interests of chartered accountants across Victoria. Garry Carnegie, FCPA, is an emeritus professor at RMIT University, and he commenced in his honorary role on the 1st of January 2018, having served in the roles of Head of School of Accounting and Professor of Accounting at RMIT from 2010 to 2017. Subsequently, Garry served as an education advisor at CPA Australia for a period of 18 months. Prior to joining RMIT, Professor Carnegie had been employed in the Australian higher education sector from 1985 and held full-time professorial posts at Deakin University, Melbourne University Private and the University of Melbourne, and the University of Ballarat, now Federation University Australia. Before joining academe, Garry gained experience in the IT industry, public accounting services, and in the financial services industry. Since 1993, Garry has been a member of the editorial board of Accounting, Auditing, and Accountability Journal, and he became associate editor in 2013. So we are absolutely delighted to have you all today on behalf of Emerald and AAAJ. We welcome the authors and we'll commence the presentation. Thank you, Paolo.
Thank you very much, Gino, and thank you also to the Emerald Publishing team for organizing and promoting this webinar, in which we will present this paper that has been recently published in Accounting, Auditing and Accountability journal. Well, I'm talking from my office here in Bologna, and well, behind me you can see my daughter's drawings. Well, we did them during the lockdown, and then I brought them to my office to color these gray walls. They have a high value for me, but well, I guess they are worthless for you. Now, suppose that these drawings become part of a museum's collection. According to accounting standard setters, the monetary value of the drawings should be included in the statement of financial position. Indeed, in a recent consultation paper, the International Public Sector Accounting Standard Board has maintained that heritage valuation for general purpose financial statements can be technically done, and besides that it should be done because the financial value of heritage is claimed to be a relevant information for users, as it enhances accountability and decision making. Now, to understand if this agenda is sensible and if it would be reasonable for public cultural institutions around the world to start valuing their collections, in this piece of research, we looked at Australia, which is one country that, together with New Zealand, has a long track record in the valuation of cultural heritage for financial reporting purposes. Differently from prior studies who have looked at this issue for shorter period of time, we do so across a continuous period of 28 years, from 1992 to 2019. Besides, we looked at how 16 cultural institutions have reported the financial value of their collections. So what kind of challenges they experienced, what kind of use they made with this piece of information. We approach this topic from a distinct angle, namely we look at heritage valuation as a paradoxical practice. What do we mean by that? Well, a paradoxical situation is one in which elements that seem logical in isolation meet. In this case, we have on the one hand professional accountants who aspire to attribute financial values to collections. On the other hand, we have heritage experts who are concerned with, you know, aesthetical, historical, cultural, social, or recreational values of the collections to society. So they are interested in the non-financial and in the multiple values of collections. Besides, a paradoxical situation is a situation that leads to outcomes that are absurd or irrational. Indeed, prior research on this topic has shown that accounting for heritage assets is a practice that is intended to improve decision-making, comparability, and accountability. But actually, it produces an information that has scarce relevance to users, reduces comparability, and potentially jeopardize accountability. So moving on this definition of heritage valuation as a paradox, we are interested in this paper to look at how 16 selected Australian public cultural institutions dealt with the valuation of collections for financial reporting purposes. Consistently with the definition of accounting for heritage asset as a paradox, and consistently with the longitudinal nature of the study, we approach the topic, we draw on processual models of paradox management. So we are interested to look at how public cultural organizations responded to the request of putting a financial value on their collections. Paradox theory provided us with a more specific, with a more narrow analytical lens to approach the topic rather than economies of worth or institutional logics. More specifically, this theory has developed, has analyzed a range of possible responses to paradoxes, ranging from defensive to active, to responses that varies according to the power relationships. Later on, Shannon, when presenting the findings, Shannon will draw on these responses to make sense of how museums have responded to the request to value collections. A few notes on our method, then of course more details can be found in the paper. We selected 16 not-for-profit public cultural institutions around Australia. We included the museums, art galleries, and institutions with specific collections. These are the most important museums in the countries, the oldest museums in the countries, and the ones with the richest collections. We collected the annual reports of these 16 institutions from 1992 to 2019. And we collected data on the value of the total asset, on the carrying value of the collection, on how the valuation was performed, any depreciation policy. Besides, we collected also other relevant additional documentation to triangulate our findings. Very briefly here on how we coded our data. Basically, we coded the response of each museum year by year. For instance, here you can see the example of the response by the National Gallery of Victoria in 2004. What we observed was that the collection was valued, no out of the ordinary increase in the value of the collection. There was no comment to this figure in the explanatory notes. The value wasn't mentioned in the annual report where museums discuss their outcomes during a year. And basically, we couldn't find any reference to the figure in any other document. Therefore, we coded the response as splitting, which is a response to tension that involves separating contradictory elements. On the other hand, you can see another example, Australian Museum 1999. Here, the museum decided not to place a financial value of the collection. So it explicitly stated that a financial valuation does not reflect the true intrinsic worth of the collection. As a reaction to that, the general auditor qualified the annual reports, leading to a sort of conflict between the museum and the auditor general. Therefore, we code the response as opposing, which is a response that involves active confrontation. Later on, in presenting the findings, we will draw on these coding to present our phases. Because actually we pinpointed 4 distinct phases, each with a distinctive nature of the paradox and a totally or partially new combination of responses. Now I'll leave the floor to Shannon, who will analyze each phase in more details, describing the responses in each phase.
Thank you, Paolo. So the first phase, which covered around the first 10 years of the period of analysis, we coded as splitting and opposing. They were the responses that we saw. So as Paolo sort of mentioned, splitting is about separating these contradictory elements of a paradox into different realms. So what that looked like in terms of the annual reports is that the financial values of the heritage collections were being reported in the balance sheet, but we didn't see them anywhere else in the report. So they weren't really paid any credence elsewhere in the annual report. They were really just confined to the balance sheet where they had to be, where it was mandated that they be. They were there, the financial values, but they weren't reported anywhere else. So in other areas of the annual report where the institutions were talking about their collections, they might have discussed the nature of the collection, the types of artifacts and objects that they held. They might have even included the number of objects. But in describing their collections elsewhere in the annual report, they did not include the financial value of the collection. Obviously, they did not see this as a relevant descriptor of their heritage collections. So that was the main response that we saw initially for that first around 10-year period. But there was a couple of exceptions. There was two exceptions, and one Paolo actually just briefly touched on in this example. We actually saw 2 institutions that opposed the mandate to report the financial values of their collection. They refused to do so, and that ended up with a qualified audit opinion, as Paolo had discussed. And for example, the Australian Museum, which was one of the opposing institutions, included a statement in their annual report to say that the true value cannot be expressed in monetary terms, but rather in terms of their cultural and scientific worth. So they were really opposing the requirement to place a financial value on their collections. And then we'll move to the second phase. So that was for about the first 10 years, the first phase. And then the second phase, which sort of ran for around 7 years or so, saw further splitting. So we continued to see that splitting where the financial values were reported in the balance sheet, but not elsewhere in the annual report. But we also began to observe what we call assimilation. And that is when the dominant party accepts some of the elements of the opposite logic to avoid any confrontation. So what that looked like in the annual reports and in the audit reports was that the auditors who could be seen as the dominant party, who sort of had the ability to sign off or not on these annual reports, seemed to tolerate extreme diversity in accounting practice. So on the surface, it seemed, oh, okay, you know, these institutions are doing the same thing in that they're all including now a financial value for their collections, and they're reporting it at, say, fair value. However, the actual approaches that were being used varied significantly. So the frequency of the valuations There was a lot of variance in that. Some institutions seem to think an appropriate approach was to index the value of the collection, perhaps with CPI. There was difference in sampling, depreciation, blanket exclusions. There was a lot of differences going on in terms of the approach being taken, but the auditors were willing to just sign that off. So we coded that observation as assimilation in the second phase. And then we'll move to the third phase if we can, Paolo. Thank you. So by the time we get to the third phase, we start to see splitting failure. So where these institutions seemed earlier on to be quite successful in just reporting the value of the financial value for financial reporting purposes in their balance sheet and not giving it any attention anywhere else in the annual report, that approach, okay, was actually no longer sustainable. What happened is there was a series of write-downs. So of the 16 institutions that we included in our analysis, 7 of them, so almost half, started writing down the values of their collections. And I'll show you what that looked like in a moment. But essentially, some of these write-downs were really quite significant. And what it meant was they couldn't be ignored. They couldn't have these huge write-downs going through their financial reports and then just ignore them elsewhere. They had to address it. The media had even picked up on these things. They were forced to actually start speaking about these write-downs. And so then what we observed in doing that, in addressing these write-downs, is this approach called suppression. And that is when one party tries to sort of minimize the relevance of the opposing logic. So for example, as I said, the media picked up on some of these write-downs, and one of the statements that was made to the media from the incoming director of the Australian Museum, so they had written down their collection by 44% in a single year. The incoming director stated, look, we've got 18 million items in the collection. There are still 18 million items plus in the collection. There is a valuation methodology that was changed. The collection hasn't changed. In other words, the financial value that we've placed on our collection last year versus this year might be vastly, vastly different, but the collection itself hasn't changed. So the numbers are essentially meaningless in describing our collection. So I'll just show you what these write-downs actually look like. As I said, there was 7 of the 16 institutions. Just put a sample of those up for you. You can see that some of them actually were really quite significant, particularly at the Australian Museum and the Western Australian Museum. You can see the values sort of creeping up over time and then taking a huge hit. So, and then there was some smaller write-downs as well during that period. And we'll move on to phase 4 if we can, Paolo. So phase 4, which was the final phase that we identified in our period of analysis, we basically observed mutual adjustment. And mutual adjustment occurs when parties sort of accept the coexistence of the opposing logic, and they try and find a way to live with it. So you might describe it as finding a mutually satisfactory, but not necessarily a mutually advantageous outcome. And what we observed with this mutual adjustment, and this was right towards the end of the period of analysis, so we're yet to really fully see how this plays out. But what we saw was the development of the Australian framework for the valuation of public sector collections for general purpose financial reporting. And that was issued by the Council of Australasian Museum Directors for use by the Australian museum sector. So under this framework, collection assets are divided into different types. So highly significant and sensitive assets are recorded at a nil monetary value. High value collection assets are recorded at their market value. And then there's general collection assets that can be valued using the cost of recollecting them. So interestingly though, although the Council of Australasian Museum Directors sort of put together this guidance on how museums might go about valuing their collections, they were very clear in the document that the intent of museums is to ensure that collection assets are preserved indefinitely. And you can read that to say, as opposed to the intent to realise a financial value for these assets. So their intent isn't to ever realise these financial values in terms of selling these artefacts. The intent of the museum is to preserve them indefinitely. So they make that very clear in the document. Another statement, for example, is that the collection assets are acquired for the specific function and purpose of becoming part of the collection, and this represents their best use. So the best use is to actually hold them as part of the collection, as opposed to seeking to realise a financial value from them in terms of selling those assets. So the language is really interesting. If we just move to the next slide, Paolo, even in the introduction to these guidelines, they say collections are treated as non-current physical assets for the purposes of public sector financial reporting. So they're really clear to acknowledge that we're not saying that these collections are non-current physical assets. We're not saying that they meet the definition of assets. We're just saying that we will treat them as non-current physical assets, specifically just for this purpose of public sector financial reporting. So they've made these sort of limiting statements. Also, it's interesting that they do sort of carve out a little bit here to say that exclusions may apply to sensitive collection assets. For example, human remains, secret objects, and culturally sensitive assets, where the museum determines that it's unable to measure value reliably or it's inappropriate to value. So they're conceding in a way we will put a financial value on the collections at some point where we need to draw a line where it's not appropriate to do so. However, we, the authors, would argue that artefacts in public collections of arts and cultural institutions are all significant in memory of past contributors to civilizations and conditions. And they're all culturally sensitive within the communities and societies in which they were imaged, designed, produced, and deployed. And they've been uniquely integral to the education of citizens across educations, regions, countries, and diverse communities. So where the guidelines have said, there may be exclusions, that apply to these sensitive assets where we believe it's inappropriate to value them, and so we won't be doing it, we would argue that all artifacts, are sensitive to somebody. They're all sacred to somebody. And, really, is it appropriate to value any of these items? And then we'll move to, if we can move on to the next slide, please, Paolo. So overall, we would describe the journey of the monetary heritage valuation as a roller coaster. And if you have a look, or if you recall back to those diagrams that I showed with the values going up and down, it really does represent a roller coaster. What we've found is that there was the splitting and more recently the mutual adjustment, and as I said, the mutual adjustments really come at the end of the research period. We haven't fully seen that play out yet, but we would expect that's going to go some way to reducing splitting failures in the future. Most of the efforts we have found have been about trying to keep the cultural and accounting valuations separated, and even the framework that was introduced by the Council of Australasian Museum Directors seeks to do that to some extent in the language that they're using. Another interesting finding is that, you know, the study illustrates that the auditors really seem to prefer this assimilation approach, whereby they seem to tolerate a lot of inconsistencies between different institutions, but also within the same institution over time as they sort of change their approach to valuation. And I'm going to now pass over to Garry, who's going to talk through more the implications of the study.
Thank you, Shannon. Thank you, Paolo. And hello to everybody who is participating. I can't see anyone except Paolo, Shannon and Gino. So if you have been waving at me, I'm sorry, I haven't been able to wave back. So that's a bit of bad luck. Now, I won't read this quote or this statement. It goes back to 1951, but I think it pretty well sums up the dichotomy of views that we have in this space. And so we'll proceed with this little quote in the background. So next slide, please. Thank you. Now, some of you will be thinking, oh, we've just jumped back into a first year accounting lecture. My God, I didn't think I'd hear this. But I'd like to ask you all seriously, what is accounting today? Now, I know you might be able to pull out a definition from a textbook, but I just would like you to think about what is accounting today, because I don't think the implications of this study can be properly considered without asking the question, what is accounting? And this is even more pertinent than ever because the International Public Sector Accounting Standards Board has issued ED 78 late April, whereby heritage assets of this kind will be required to be valued in financial terms for financial reporting purposes. And I feel this is going to be pretty uncomfortable for a lot of the top class museums, galleries, etc., all around the world. But the traditional definitions of accounting go a long way back. In fact, you can go back to 1941 when the American Institute of Accountants, now the AICPA, came out with a definition that you can still find on the website if you look it up. There's a number of places you'll find this. In fact, I would say it's probably the most quoted definition on the website. And you might even be able to recite this if you've been teaching it for many years. But accounting is the art of recording, classifying and summarising in a significant manner and in terms of money, transactions and events which are, at least in part at least, of financial character and interpreting the results thereof. Now, some of you might be thinking, oh my God, I hope we're still not teaching that. And I bet you are. In various, if not a great number of places across the world. Now, our proposal, and I say our, it's a few people at RMIT, myself, Lee, and Eva. You'll see some references down there, but we wanted to take our understanding of accounting beyond merely a technique of accounting or a technique of recording and reporting financial transactions and events. Now, this is not the only definition of accounting that could be proposed, but this is what it says, and I will read it just so there's no misunderstanding. Accounting is a technical, social and moral practice concerned with the sustainable allocation of resources and proper accountability to stakeholders to enable the flourishing of organisations, people and nature. Why not? because we all need to get a go in this world. Now, when you look at that definition, you can see accounting is perhaps a little more engaging and a bit more complicated than meets the eye when you read out a 1941 definition of accounting. So the next slide, please, Paolo. And we're just going to run through very quickly these three conceptions of accounting. Accounting is technical practice. Now, I'm not really going to talk about this because this is what we've been hammering home to students in accounting for a very long time, and we're still doing it. And the textbooks are getting thicker and thicker. They're so heavy, a lot of students can't even carry them in their backpacks. Anyway, this is all about the technical side of accounting. There were some authors in Australia said that accounting as technical practice is essentially a comprehensive set of techniques, concepts and practices resulting in the preparation of accounting reports. However, and I think a lot of people tuning in tonight will be very well aware of this, but since the early to mid 1980s, so we're going back quite a long time, researchers in accounting have been assessing the impacts of accounting. And they've been paying greater attention to, if you like, what does accounting do, so to speak, or what would be the impacts of accounting? Because we know accounting impacts on all of us. We all have KPIs of some form or another, and KPIs, of course, are prepared mainly by accountants in accounting offices and so on and so forth. So accountants do keep people up at night because of the KPIs that are either too unrealistic, too stretched, or too incentivized. Next slide, please. Accounting is also a social practice, and this goes back to the research in accounting since the early to mid 1980s. There's a whole host of people who've done research in this area. Anthony Hopwood, his 1983 piece in AOS, studying accounting in the context in which it operates, which is a theme that very much underpins this presentation. But I'll just say a couple of things. Accounting comprises both ends and means, but the means are just done to death in accounting, just completely done to death. And the ends don't get much attention at all. We'll tell people, oh, information is useful for decision making and for accountability purposes, and that's about the end of the ends. So it's a pretty short end. But since this time, accounting has become an object of study less as technical practice and one as pervasive, enabling, disabling social phenomenon. So accounting is increasingly recognised in the academic literature for its effects on and reflections of our behaviours and our actions in organisations and society. So, in other words, accounting impacts on us. Accounting changes our behaviour. Accounting changes organisational culture. Accounting drives governance and so on. Accounting is incredibly influential and powerful. And the next slide, please. Accounting is also moral practice. Now, if you don't believe that, I'll just remind you of a few things about the moral side. Accounting is not independent of or disconnected from morality. Indeed, morality is at accounting's core. You can't discount morality away and say it's all about the technical. What are the ingredients of this? Well, particularly external audit, internal audit, audit committees, code of ethics for professional accountants, independent boards of directors with non-executive directors, and so on and so forth. Yes, accounting is about reporting what evidently has gone on. In other words, accounting has to be rigid-edge, dinky-die, or true and fair. So accounting and moral practice and morality go hand in hand. They're not separate ponies. So accounting cannot be adequately summed up as a mere technical pursuit. However, when you read documents like a International Public Sector Accounting Standards Board document on heritage assets called a consultation paper, you do get the very strong impression that accounting is a technical practice with lots of claims made about the virtues of accounting in this way. So, moving on, Paolo, I'd just like to make a couple of general comments about museums or cultural heritage and arts institutions. These are not-for-profit public cultural institutions are custodians. They are not the owners of the collections. Who owns the collections? We do, the public. So these organisations, although they might look as if they own everything, they don't own any of it. They're just custodians of these items. Objects or artefacts in public collections, by virtue of their dedication for community use, are off the market. They are exempt from market forces. Indeed, collections owe their creation and existence to being set purposely aside in a special domain, where artefacts are protected by acts of parliament, which enabled these institutions to be established, such as is the case in Australia, or by their constitution, or by other rules or laws in a given country. As a result, these collections are effectively removed, at least in conceptual terms, from the cut and thrust of the economics of the marketplace. This is why people in museums don't care about financial values at all. It's not their brief. The collections, however, are to be preserved and conserved into perpetuity. They are utterly misplaced by their recognition in statements of financial position. They are not financial resources, but when you record them as assets, they are seen for what they are not in the context in which they are placed and which they are enjoyed and used for the public. So if we go back, Paolo, to the earlier slide, I'd just like to wrap up those three conceptions of accounting. If you want to try to explain this to your students and see how you go, a technical practice is really about the question of how to do accounting. Okay, this is how we do it. Sit down, I'll give you the numbers, I'll put them up on the board. Beauty, right, correct. Social practice, we ask the question, what does accounting do? What would this new standard do? What would happen in the world if this occurred? And moral practice is, what should accounting do? Or, in this case, what should accounting not do? There has to be morality underpinning what's done in accounting. And when you think of auditing and assurance, no one will disagree with you. Okay, so the next slide, we look at accounting as technical practice, particularly this one, the monetary valuation of collections. Now, this is not a lay down misere by any means. I've been working in this area since the early to mid 1990s, even though I look a lot younger than that. But all I can say to you is this practice is highly problematic and controversial. It is controversial. Are collections financial assets or financial resources? I'm going to say there's been very big arguments about that, and you can argue very successfully both ways using vague and abstract definitions of assets and so on that you'll find in conceptual frameworks. Do collections meet the asset recognition criteria of representational faithfulness and probable future economic benefits of a financial nature? Now, the very words representational faithfulness tell me that this is not going to work in the museum field. It is just too high a test to try to pin down financial values for one-of-a-kind items that are priceless, that may have been worn by Captain James Cook, or may have been the hide of Phar in the Victorian museums. These are not about financial values. These are about other values. They are non-financial in kind. Are financial valuations of collections meaningful in the statements of financial position? Given the the purpose of museums, their missions and objectives, you won't find any reference to these financial valuations in those formal, often constituting documents. Do the costs of financial valuation of collections exceed the benefits? You might think so. Are priceless artifacts auditable? Now, is that a contradiction? Now, I can't see anybody, so you might be nodding or shaking your head. Are auditors that good? Are auditors able to audit priceless artifacts? Does anyone believe that? It has to be a contradiction. And who are the users, the stakeholders who need and demand this information? Please stand up and tell us who you are and tell us what decisions you want to make with this information. And what are the intended and unintended uses of this information? I'll give you an example of an unintended one very soon. And here we have what decisions are being made. So next slide, please. Now, back in 1995, Peter Wollnizer and I wrote a piece in the Australian Accounting Review, and we posed 4 questions, and later on we asked another 2 questions. And there's been various people writing in their articles saying, why haven't these questions been answered? I'm not going to read these questions to you. They're easily looked up, easily found. But I can tell you at the time of this presentation tonight, none of these questions have been answered by accounting standard setters. And look, to be frank, I'd like to know why. I don't think I'm asking too much. With Peter Wollnizer, I've gone to the bother of writing these. They were thought through and they're being ignored. Well, looks like it. So I'm going to ask another question to make it 7. Why is this so? Now, moving on to the next slide. I wanted to give you 2 examples of this particular practice being identified as a social practice and another one as a moral practice. The first one I have is the National Library of New Zealand, which about 20 years ago were required to place a financial valuation on their collections. They certainly didn't want to do it, but they did, and they came up with a valuation in New Zealand dollars of 522 million. And then along comes the government and said, we're going to introduce a capital charge on your assets, and we're going to do so for government departments. And it just so happens to be the National Library of New Zealand is a government department. And the capital charge was, I think, something like 9.8%, but we can say 10% just to make it easy. And so this was going to be a payment in 1 year of 52.2 million by the museum, or the library, I should say, to the New Zealand government. Well, for a while, the New Zealand Library was trying to work out how it could raise the funds. It even came up with a proposal to sell the Milton collection of the National Library in New Zealand. Seriously. But it eventually got out and hit the press. And something had to be done because nobody wanted the Milton collection sold. So what happened? We can deal with this. So what we'll do is we'll move the asset out of the books of the National Library of New Zealand and we'll put it up into the accounts of the Crown or the government. So that means that the asset is existing in the overall whole of government accounts of New Zealand, but it doesn't appear in the books of the National Library of New Zealand. Bingo, problem solved. They don't have to pay a capital gains check. A capital usage charge. These are things called unintended consequences, and if you want to believe they're unintended, good. But some people would argue these are intended at some stage in the future. Another example I've got here is the State Library, the State Film Centre of Victoria. What happened here is this organisation had to value its collection. These are basically historic or antiquated movies and videos and things like this. They had no idea how to do it. I was involved with them at the time, talking about it. Anyway, they said in the end, what we'll do is we'll just measure how much film we have in each of our, if you like, rolls or reels of film. How many meters? So this one might be 100 meters and this one might be 200. And so they worked out the entire meterage of the film collection, then went to Kodak and said, can you tell us the cost of just plain new film? And what we'll do is we'll multiply that by the total length, and that's our financial value. Now, if you think that's a legitimate means of accounting, good on you. Try to tell your students that. But this is the sort of thing that goes on. And auditors have just been happy to get a number, which is why they've also been happy to sit back and not worry too much about changes. Next slide, please. We're just about there. So what has been argued about this practice in the past? You'll see my name there a couple of times. I apologise for that, but it's been called an accounting fiction. I still believe that. This whole idea, in my view, is an accounting fiction. It has nothing to do with accounting in the context in which these collections are held. We also mentioned it was an accountability mirage. These people running these institutions are not accountable for the financial values of their collections. They are not accountable. And any academics listening, you're not accountable for 100% of your students passing. You are not. This sort of thing led Carnegie and West to state in their article, the title, Making Accounting Accountable in the Public Sector, because we got the impression that perhaps accounting needed to be more accounting itself, given some things going on in this sector. And against this backdrop, given the fact an ED is out there and comments close on the 25th of October this year, this is the last sentence in our paper, now published in AAAJ. Will the international accounting profession, represented by IFAC, especially by the International Public Sector Accounting Standards Board, prove to be sufficiently accountable or not in making its next move on this now long-standing international accounting controversy? What do you think? And just to sum up, I think IFAC's starting to rethink things, because if you remember the slide put up by Paolo, and if you could go back there, Paolo, to the slide about what is accounting, you'll notice that IFAC have published a piece entitled Redefining Accounting for Tomorrow. You'll be able to see it right at the bottom of that slide, written by the three of us again. And it's on their thought leadership platform, which they call Knowledge Gateway. It was published on the 6th of April, and it carries this definition of accounting. So I'm actually starting to feel a little bit upbeat about this, because I think IFAC, by publishing this, recognise there's value in having a discussion or debate about this very point. So I'll close off now, and thank you very much.
Thank you. We've certainly ended on a high note, Garry. Thank you for that rousing end to the presentation today. For those that have posed questions, there are quite a few of them. They will require some kind of technical treatment, so in other words, a written response. I'll start with the first question, though, just as something that we can perhaps have a conversation about, and this is posed by Richard Simmons, and perhaps Paolo might be the one to have a go at answering this. So Richard poses the following: why did you just look at valuing the museum collections? Why not include the cultural value of the built heritage? This is especially important in a European context. For example, how would one value the public realm built heritage of Venice? Paolo, would you like to have a crack at that one?
Well, he or she shouldn't do so. You know, it would be. Well, actually, it really depends on the ownership of the building, on what functions is that building having in that specific city. If it is an historic building open to the public, designed to host the public at public museum, then I would say that the same critique we are applying to the collections should hold here. Otherwise, if you are talking about an historic building which has been refunctionalized to host a hotel or a restaurant, then it's clearly designed to generate profit, and it could indeed be being valued. It really depends on the use, on whether we decide to take those assets out of the market or use them to generate a profit.
Yeah, thank you. We've got another great question, and just a note to Richard, we will be responding fully to your other questions too. They will come back to you. We've got a question from Hang Tran, and the question is, Garry, instead of saying audit as an ingredient of accounting as a moral practice, could we say auditing is also a technical, social, and moral practice?
Yes.
In and of itself. Okay.
Yes, the answer is yes. I think accounting and auditing have been, in a way, dealt the same hand. They've been handled very much as a technical issue, and I think the accounting profession, to move forward, has to broaden up. And I think IFAC might be thinking we need to talk more about that as well.
Right. Okay. We've got another great question. This one, Shannon, if you'd like to have a go at this. What do you think motivated the write-down in value of the collections at the end of the second period? Was it fear of a capital charge like the New Zealand situation that Garry discussed?
Oh, that's a great question. And there's more information on that provided in the paper as well. We talk a little bit more in detail, but a lot of it was actually just engaging different valuers. So a lot of these institutions engaged external valuation professionals to provide a valuation, and after switching valuers and valuers providing or applying different techniques, which was it's so easy to do, because I mean you can just pull figures from anywhere when something's not available on a market. They're really priceless items. So a lot of these happened because they were slowly valuing more and more of their collections. The values were getting quite high. They switched valuation professionals, and then applied different techniques, and then that reduced the reported values. There was also some of the descriptions as well were really specific. So there was a particular item like a steam engine, and it became the last functioning one, anywhere in the world. So suddenly it was more unique than it was previously, and so then it couldn't be valued. Its value was so you might think that would increase the value, but actually it became so unique and rare that it couldn't be valued, and so then that actually brought the value of the collection down. So there's some more information in the paper about the reasons for the write-downs.
Okay, and we'll perhaps close with this one. Thank you for that answer, Shannon. So Professors Shannon, Paolo, and Garry, what is the significance of this study for future researchers in accounting? Should we focus more on valuation for museum heritage and differentiate them, such as cost valuation and market valuation, etc.?
if I just answer that one, Peter Wollneiser and I, back in the mid-90s, were not anti-everything. We actually wrote a piece in AAAJ, which was the 1996 piece called Enabling Accountability in Museums. And we called for a whole range of factual and informative measures, financial and non-financial, but measures to actually judge how well these museums were operating, as opposed to how wealthy they were, because it's not something they think about. But the accounting profession does, and so we have a complete cultural clash here. But if anyone was to ask me what I'd put in a submission to the International Public Sector Accounting Standards Board by the 25th of October, I would put down that this article was intended to provide a solution to the problem of how to deal with heritage in accounting. In other words, it can be done, but quite differently. And already we know in the world, accountants and standard setters are starting to talk about standards for non-financial information. This would be a great sector as a case study to really make it happen.
Thank you for that answer. With that, we come to the conclusion of today's webinar. On behalf of Emerald, I'd like to thank everyone that registered and also those that dialed in today. Really thank you very much. But also, I'd like to give a heartfelt thanks to our panelists and presenters today, Dr. Paolo Ferri, Dr. Shannon Sidaway, and Emeritus Professor Garry Carnegie. Thank you for this wonderful presentation and discussion. We look forward to sending out the responses to the questions that were posted in the chat today. A link will also be provided to this particular journal article, which is now available as an open access article via AAAJ. So I thank you all and have a great rest of the day and evening.
Thank you.
Thank you all.
Bye.
Thank you.
Bye-bye.